they couldn't even figure out the present, much less the future. So let that be a lesson. You can't do it.
All right, gentlemen, it is official. The new administration now firmly in place. In the past, before this happened, we talked about a lot of things that could happen, especially if you get executive and legislative branches all with one party. There's a history of what happens in the first year of a new administration. Joe, do you see anything that's going to be different this time?
Well, yeah, there's always going to be different things, I suppose. And I guess the big difference here is that at least, this very start of the administration, when he started the first time, I've said this, and I think other people have said it, and even people close to Trump have said it. He didn't expect to win the first time. And so it was kind of like the dog that caught the car. It's like, oh my God, what do I do now? Well, now he knows what to do now. He knows how all these things work together and so forth. So he knows some things. And he comes in yesterday, the first day, and signed, I don't know, hundreds of executive orders. And look, from a political standpoint, we could have a long discussion about the power of the executive these days, the power of the president, which I think is out of control. And it doesn't matter which president you're talking about. Executive orders probably ought to be very limited, and they're not anymore. But that's not my job to analyze the political side of it. I don't like it, but whatever. And the point is, he signed hundreds of these things yesterday about a wide range of things, and you might like some of them, you might not like some of them. For us, there really wasn't anything, I don't think, that was really directly related to markets and the economy. Maybe some things I'm trying to go through them all, actually, so I don't really know exactly what some of them are. I will say that we did get a taste yesterday of what we can expect. And it shouldn't be a surprise. I mean, we know this from the first term. Look, I've said it before. Donald Trump is unpredictable, and I don't think it matters. I mean, I'll just give you an example. Well, that's probably not a great example, but I'll just say that if you think you know what he's going to say or do, you are wrong. And even if you're on his team, there are times where you're going to say, "Well, that's not what he meant. He meant this," and then he's gonna come out and prove you wrong. Because that's just the way he works. Anyway, the point is that he is I've said it before, chaos personified. And so we got a little taste of that yesterday. So in the executive orders, there was nothing about tariffs, which is the thing that everybody is focused on in financial markets because we don't know what he's going to do, and figuring out the impact on trade and the economy as a whole in these trade economics is hard. It is really hard. And so it would help if we had some inkling as to what he was going to do. But anyway, there was nothing in the executive orders about tariffs. But later on, when he had the press in the Oval Office, he was signing these things. Somebody asked him about it, and he said, "Oh, I think we're going to put 25% tariffs on Canada and Mexico on February 1st, and I think we'll do it on February 1st." It was kind of like he just did it off the top of his head. It was like, "Oh, I think we'll do 25%, and I think we'll impose it on February 1st." And nobody knows what to think. And so, because there was nothing in the tariffs initially about in the executive orders, the S&P futures had been up 30, 40 points. And because people were like, "Oh, well, maybe he's going to back off on this a little bit." And then when he said that, the futures went from 40 up to 20 down in a matter of minutes because the market and the economy, the market in particular, doesn't like tariffs. And we're going to be talking about this a lot over the coming months. Tariffs are a policy that doesn't work. Well, the quote at the top of my thing this week, top of my commentary, is a quote from H.L. Mencken that says, and I'm just going to bring it up because I don't want to misquote it. I've seen it many times before. I want to make sure I get it right, exact wording. It says, "For every complex problem, there is an answer that is clear, simple, and wrong." And that's kind of where we are with tariffs. It seems really simple, right? It's like we want to have more things manufactured here and buy more American things and buy less imported things. Now, why exactly we want to do that is a long, different discussion, but suppose we do. So, well, if we just put a tax on the things that we import, then we'll import less of them. Yeah, except it's not that simple. One of the reasons in a floating exchange rate environment that doesn't work is because currencies adjust. And we've already seen that happen since even starting before the election, when it started to become, I guess, more clear to the market that Trump was going to get elected. The dollar's gone up, the Chinese yuan has gone down, the euro has gone down. Why? Mexican peso has gone down, Canadian dollar has gone down. Why? Well, because we're going to impose tariffs on them. So think about what that means. If we impose tariffs to raise the price of imports, which would mean theoretically supply and demand, simple supply and demand, that we buy fewer of them, well, the dollar going up makes them cheaper again. And so that's kind of the whole point of free floating currencies. And by the way, the Chinese yuan is not a free floating currency. It's managed by the Chinese government. So it's only gone down 4.5%, whereas the dollar's gone down 9%, and the euro's gone down almost 9, 8 and change. Why? Well, because the Chinese didn't let it fall. And that's at the root of our big trade deficit with China. They've kept the yuan undervalued for a very long time. That's their cheating that I refer to in the weekly commentary. They've been cheating because they keep their currency suppressed, and a lot of other things too. There's a whole bunch of things that China does from a, call it mercantilist policy, call it whatever you want, where from our viewpoint, we say, hey, they cheated. And back in the old days when you had Bretton Woods, you had a set of rules. If somebody cheats, here's what you do, and one of those things was impose tariffs. But remember, we were on a modified gold standard then. It's not the same thing. Currencies couldn't adjust by themselves. You had to do it overtly. You had to say, we want this currency to go down to this level. And they would just peg it and make it so. Well, it doesn't work that way anymore. Now the currencies adjust in the open market. But the point is that raising tariffs is not going to solve the problem. And the reason it's not going to solve the problem is because it's not the cause of the problem. If you want to solve the trade deficit problem, and by the way, I'm not convinced that it's that much of an issue. Look, there's a whole long discussion there about why we have fewer manufacturing jobs today. There's a whole bunch of that has to do with automation that has nothing to do with trade. That's beside the point. That's a political discussion to some degree. The point is that this doesn't, if your goal is to reduce the trade deficit, putting tariffs up is not going to accomplish your goal. So we know that's not going to work. So why are we trying it again? Well, I don't know, but it doesn't matter because they're going to try it. So the market is going to react to all those things. Tariffs distort the market. They just don't distort the market. They distort trade patterns. They distort the economy. And because they do, it's going to have an impact on markets. And trying to figure out what those impacts are is really difficult because there's a lot of moving parts there. In fact, it's probably not completely predictable. There are some things we can predict, but overall, it's very difficult. And by the way, I would point out too, there's always complicating factors, right? Okay, theoretically, the dollar should go up. The currencies of the countries where we're imposing tariffs on should go down to offset the tariffs. That's fine, except here's another little just wrinkle to throw in there. And I pointed this out in this week's commentary. We're starting at a place where the dollar is already overvalued. And so I'm not sure that you're going to get that much more upside on the dollar because, again, it's, in my opinion, quite overvalued. Some of the things we pointed out in the weekly commentary, the fact that, for instance, you can earn the median income in Japan by working at a fast food restaurant in California. That tells you that the dollar is overvalued. Same thing with any number of other professions. A gas station manager in the United States makes more money than a doctor in Spain or Italy. That doesn't make sense. And so because it doesn't make sense, it doesn't make sense because the currencies aren't properly valued. And so the dollar's overvalued. We're starting at that point. And in fact, listen, that theoretically, if you want to solve the trade deficit, if you really want to solve it, the dollar has to go down. Think about what that means. It means that to some degree, the prosperity that we have, and I realize it doesn't extend to everyone in the country, but the prosperity that we do have is artificial. It's artificial because the dollar's overvalued. And eventually that will get solved. I don't know how it's going to get solved, but it will get solved. And so it's a very confusing time, and President Trump is unpredictable, and he's going to say things and do things that the market's not going to like, and he's going to say and do things that the market loves. And all those things are going to combine to give us a little more volatility, or maybe a lot more volatility than we had under Biden. That doesn't mean Biden's policies were better, by the way. It just means they were conventional. People knew what to expect. Donald Trump is, if nothing else, he's unconventional, he's unpredictable. That adds this element of uncertainty to the market. And let me just say too, it's not just the market. It is the economy too. The things that he talks about do have an impact on the economy. Um, last week we talked about the Philly Fed survey, and I got to thinking about, and when I said at the time, hey, this seems like great news, right? It looks manufacturing's picking up. We've been talking about this for 6 months. And I think that is true to some degree. But to get the jump that we did, I actually think it has more to do with the tariffs. And the reason I say that is because I guarantee you, if you know that tariffs are going to go up and you're a company that buys things from outside the United States, you're out there buying tons of them right now because you don't know when the tariffs are going to come and you're going to stock up. And so we may be seeing a lot of that over the next few months, assuming he doesn't, impose tariffs very soon. You're going to see companies stocking up on things that they wouldn't normally be stocking up. They're going to be buying things they wouldn't normally be buying because they're trying to buy them before the tariffs hit. And what does that mean? Well, it makes the economy look artificially strong now, and it'll make it look artificially weak later. So again, those things all have to be factored into what we're doing as investors. And here's the last thing. Most of it's just noise. You got to be careful not to overreact to it because you could just end up doing something that, like, for instance, he could say, we're going to put 25% tariffs on Canada. And by the time you get to February 1st, he goes, never mind. So you got to be really careful about what you're doing out there. And I would suggest that for most investors, what you need to do is zoom out a little bit. Don't be focused on the day-to-day stuff out of the Trump administration because it's going to drive you crazy. So anyway, that's my take on it. It is what it is. We'll deal with it. We dealt with it in the first term. I'm not new to this. Neither is anybody else at this company. We've done stuff like this before, so we'll do it again and we'll get through it.
Steve, along with uncertainty with any new administration, there's that old phrase that tends to be true: the first year is the worst year. Any reason to think that won't be true this time?
Well, if you're talking about the presidential cycle, one reason would be sometimes the second year is pretty bad too. But that's not being optimistic about this. But just going on that, the reasoning behind that cycle is really uncertainty. That when you have a new administration come in from whichever party, it's really the first 2 years where they're going to do any major changes, and the market's going to have to adapt to that. It can be disruptive. And also, we kind of get into this, but in behavioral finance, they've measured loss aversion at like up 2.5x. So the people getting stuff taken away from them react 2.5 times more than the people getting stuff out of any sort of policy change or whatnot. That's the kind of psychological part of this. But there's a real part of this too that Joe kind of alluded to or spoke to in terms of the tariffs may cause people to stockpile, which generates increased economic activity. On the converse, you also have businesses that hold off on investing and hold off on doing things and deploying capital until they have a more clear picture of what's the tax code going to be, what's the regulatory environment, what's going to get subsidized, what isn't going to get subsidized, what's going to get penalized. And in a way, that's actually a possible bright spot here, is that if we can actually start clearing some of this up and getting some more visibility in terms of what actually is happening, you could see businesses more willing to deploy capital and spend and do plans, which just another way of saying it's confusing as heck in terms of, the forces that actually delay activity, the forces that kind of bring forward activity. But the net has been over time, we've seen higher risk of downturns and less returns in those first 2 years of a presidential cycle, but there's always exceptions. So you kind of back using this as a data point that you need to pay attention to. So yes, you kind of need to pay attention, I think, to what Joe's talking about. You're going to probably be operating in a more volatile environment. And here's the kicker in that. It probably argues for doing less rather than doing more because there's going to be a lot of noise that can kind of kick you out of potentially good positions. So I think that's really kind of the messed up message here. Pay enough attention, know that you should be paying less attention. So don't let the noise affect you too much. We're probably going to get some volatility here, but the noise itself, the volatility itself, isn't what's meaningful. It's really the other data points around the economy, around market reactions that we'll be paying attention to, and you should too.
Well, Joe, I want to follow up on what Steve just said. With this much I don't know, then what do we do in the investment arena?
Well, we do what we always do. Listen, we're talking about what is the impact of the tariffs. Well, we don't know what the impact of the tariffs is going to be because we don't know what the tariffs are going to be. We don't know who they're going to be imposed on. We don't know what the response will be. We don't know what the retaliation will be. Historically, though, I will tell you that if we impose tariffs, somebody will impose retaliatory tariffs, and that's kind of the problem. It's tit for tat. But I think that we're going to do what we always do, which is we take things as they come. Listen, I think everybody in this business wants to tell you what the future holds. They all focus on the future and say, hey, we're going to try to figure out how all this is going to play out. And I got to tell you, if you're trying to figure out what Donald Trump and his administration are going to do over the next 2 years, you are banging your head against the wall, man. There's no way to figure that out. It's hard anytime. But with him especially, it's just that much harder. Oh my gosh. So we are going to do what we usually do, which is we're not going to try to predict the future because you can't do it. So what we're going to do is we're going to watch the markets and we're going to see how the markets react. We're going to let the markets provide us with the intelligence we need to make changes to the portfolios when we need to make them. And what that means is, look, and by the way, you have to be a little bit careful about that. Markets overreact some. Markets overreact all the time, so you have to be careful about it. But the bottom line is that the market will tell us what the market expects, and that wisdom of crowds does work. And it's the only thing that's going to get. I'll put it this way: it's the best view of the future you're going to get is the market and how it is today. I think the big fallacy in this business is that you have to predict the future to be successful, and you don't. What you have to do is react to the way things are in a measured way and in a proper way. Be clear about the way things are right now. Listen, that isn't as easy as it sounds. What is the state of the economy right this minute? Well, look, if that was easy, I can tell you this. In the summer of 2008, you wouldn't have had, I don't know how many people on Wall Street going, I think we're going to avoid a recession. Because it didn't look like we were in a recession. In fact, if you go back and read stuff in 2008, until you got to the fall, most people did not think we were in recession. And if you go back now and you look at the dating of it, it was actually the end of 2007 when it started. The point is, nobody even knew we were in recession. So they couldn't even figure out the present, much less the future. So let that be a lesson. You can't do it. But pay attention to the present. Pay attention. As Steve said, now I thought that was a great line, Steve. You got to pay attention enough to know that you don't need to pay attention. I have to use that, Steve. I'll be using that in one of my commentaries. Look, it is what it is. You can't do anything about the future. It's going to happen the way it happens, and you can't figure it out ahead of time. So don't try. So that's what we're going to do. We're going to do what we always do. And it's worked for us for a long time, and we think it'll keep working.
Well, that's a great phrase that, Joe, you've used a lot. Don't try to predict the future. Just do your best to interpret the present. Have comments? Give them to us down below.